Chapter 6 Financial Markets 2 The Extended ISLM Model. This chapter extends the ISLM model by introducing a richer financial system and uses it to explain what happened during the financial crisis. Until now, we assumed there were only two financial assets, money and bonds, and just one interest rate, the rate on bonds, determined by monetary policy. The financial system is vastly more complex. There are many different rates and many financial institutions. The financial system plays a major role in the economy. In the United States, financial activity accounts for 7% of GDP, a large number. Before the 2008 crisis, the importance of the financial system was downplayed in macroeconomics. This chapter looks more closely at the role of the financial system and its macroeconomic implications, and then gives an account of what happened during the Great Financial Crisis. Chapter 6 Outline Financial Markets 2. Section 6.1 introduces the distinction between nominal and real interest rates. Section 6.2 introduces the notion of risk and how it affects the interest rates charged to different borrowers. Section 6.2 introduces the notion of risk and how it affects the interest rates charged to different borrowers. Section 6.3 looks at the role of financial intermediaries. Section 6.4 extends the ISLM model to integrate the above. Section 6.5 then uses this extended model to describe the recent financial crisis and its macroeconomic implications, going from a housing problem to a financial crisis to an economic crisis. If you remember one basic message from this chapter, it should be the financial system matters and financial crisis can have large macroeconomic effects. Section 6.1 Nominal versus real interest rates. Nominal interest rate is the interest rate in terms of dollars. Real interest rate is the interest rate in terms of a basket of goods. We must adjust the nominal interest rate to take into account expected inflation. In January 1980, the one-year US T-bill rate, the interest rate on one-year government bonds, was 10.9%. In January 2006, the rate was only 4.2%. It was clearly much cheaper to borrow in 2006 than it was in 1981. Or was it? In January 1980, expected inflation was around 9.5%. In January 2006, expected inflation was around 2.5%. To make an accurate comparison, we must adjust the nominal rates to take inflation into account. Figure 6.1 shows definition and derivation of the real interest rate. The top part repeats the definition of the one-year real interest rate. The bottom part shows how we can derive the one-year real interest rate from information about the one-year nominal interest rate and the price of goods. Let's go through the step-by-step derivation. Uppercase P with subscript lowercase t represents price of a good today. I will call it PT. Lowercase r with subscript t represents one-year real interest rate or real return in terms of goods. I shall call it RT. Lowercase I with subscript t represents one-year nominal interest rate. I shall call it IT. Uppercase letter P with superscript lowercase letter e and subscript 1 plus t represents expected price level after 1 year. I will read it as PET plus 1. If you loan money today in terms of goods, say a cup of rice, then after 1 year you get back a little over 1 cup of rice. Then the extra rice you got is the real return on your loan. One good today is after 1 year equal to 1 plus RT goods. To derive the formula for the real rate, start by considering you invested in one good by buying it for its price PT. After a year, if nominal interest rate is IT, then you have PT times 1 plus IT dollars. After 1 year, the expected price level will be PET plus 1. If we adjust the nominal return by dividing it by the new expected price level, we will get the real return or the real interest rate earned on the investment of buying one good for PT dollars. Equations 6.1, 6.2 and 6.3 help us in understanding the relation between real interest rate, nominal interest rate and expected inflation rate. Equation 6.1 shows the derivation of the real interest rate by putting together the top and bottom parts of figure 6.1. 1 plus RT equals 1 plus IT times PT over PET plus 1. Two simple manipulations will give us a simpler formula for calculating real interest rate from nominal interest rate and the expected inflation rate. Denote expected inflation between t and t plus 1 by the symbol pi with superscript lowercase letter e and subscript lowercase letter t plus 1, which I will read as pi e t plus 1. So, pi e t plus 1 equals, within bracket, p e t plus 1 minus pt, and the difference divided by pt is equation 6.2. Equation 6.2 says the expected rate of inflation equals the expected change in the price level between this year and the next year divided by the price level this year. Using equation 6.2, rewrite PT over PET plus 1 in equation 6.1 as 1 over 1 plus pi e t plus 1. Replace in equation 6.1 to get 1 plus RT equals 1 plus IT over 1 plus pi e t plus 1 as equation 6.3. If the nominal interest rate and expected inflation are not too large, a close approximation to equation 6.3 is given by equation 6.4 below. RT approximately equals IT minus pi e t plus 1, which says that the real interest rate in year t is approximately equal to the nominal interest rate in year t minus the expected inflation rate over that year. When expected inflation equals 0, the nominal interest rate and the real interest rate are equal. Because expected inflation is typically positive, the real interest rate is typically lower than the nominal interest rate. For a given nominal interest rate, the higher expected inflation, the lower the real interest rate. Make sure you remember equation 6.4. It says that the real interest rate is approximately equal to the nominal interest rate minus expected inflation. In the rest of the book, Blanchard often treats the relation in equation 6.4 as if it were an equality. Remember, however, it is only an approximation. nominal versus real interest rate in the United States since 1978. Figure 6.2 shows the importance of adjusting for inflation. Although the nominal interest rate was much lower in 2006 than it was in 1981, the real interest rate was actually higher in 2006, about 1.7%, than it was in 1981, about 1.4%. Put another way, despite the large decline in nominal interest rates, borrowing was actually more expensive in 2006 than it was in 1981. This is because inflation, and with it expected inflation, has steadily declined since the early 1980s. Nominal versus real interest rates, the zero lower bound, and deflation. So, which interest rate should enter the IS relation? Clearly, in thinking about consumption or investment decisions, what matters to people or to firms is the real interest rate, the rate in terms of goods. This has a straightforward implication for monetary policy. Although the central bank chooses the nominal rate, it cares about the real rate because this is the rate that affects spending decisions. If the central bank wants to set the real interest rate equal to R, it must choose the nominal interest rate I so that, given expected inflation pi e, the real interest rate R equals 1 minus pi e is at the desired level. For example, if it wants the real interest rate to be 4% and expected inflation is 2%, it will set nominal interest rate I at 6%. The real interest rate, I minus pi e, is based on expected inflation, so it is sometimes called the ex ante, before the fact real interest rate. The realized interest rate, I minus pi, is called the ex post, after the fact interest rate. The interest rate that enters the IS relation is the real interest rate. The zero lower bound of the nominal interest rate implies that the real interest rate cannot be lower than the negative of inflation. So long as expected inflation is positive, this allows for negative real interest rate. But if expected inflation turns negative, if people anticipate deflation, then the lower bound on the real rate becomes positive and can turn out to be too high. Check out focus box in chapter 9 on deflation in the Great Depression. It shows between the years 1929 and 31, nominal interest rate I was lowered from 5.3% to 3.1%. Real interest rate increased from 5.3% to 12.3% because inflation rate went from 0% in 1929 to negative 9.2% in 1931. Risk and risk premia. Until now, we assumed there was only one type of bond, but bonds differ in several ways. They differ in terms of maturity, i.e., the length of time over which they promise payments. For example, 1-year government bonds promise one payment a year, hence, 10-year government bonds promise a stream of payments over 10 years. They also differ in terms of risk. Some bonds are nearly riskless. The probability that the borrower will not repay is negligible. Some bonds instead are risky, with a non-negligible probability that the borrower will not be able or willing to repay. In this chapter, we shall focus on risk, leaving aside the issue of maturity. Some bonds are risky, so bondholders require a risk premium. Let I be the nominal interest rate on a riskless bond. I plus X be the nominal interest rate on the risky bond, which has a probability P of defaulting. Call X the risk premium. to get the same expected return on the risky bonds as on the riskless bond, the following relation must hold. 1 plus I equals within bracket 1 minus p times within bracket 1 plus I plus x close bracket plus within bracket p times within bracket 0. The left hand side gives the return on the riskless bond. The right hand side gives the expected return on the risky bond. With probability 1 minus p, there is no default and the bond will pay 1 plus I plus x. With probability p, there is default and the bond will pay nothing. So that reorganizing gives x equals 1 plus I times p divided by 1 minus p. So for example, if the interest rate on a riskless bond is 4% and the probability of default on the risky bond is 2%, then the risk premium required to give the same expected rate of return as on the riskless bond is 2.1%. For small values of I and p, a good approximation to this formula is simply x equals p. Neither you nor I can borrow at the federal funds rate set by the Fed, nor can we borrow at the same rate as the US government. There is a good reason for this. Whoever might be lending to us knows that there is a chance that we may not be able to repay. The same is true for firms that issue bonds. Some firms present little risk and others more. To compensate for the risk, bondholders require a risk premium. Risk premia are determined by the probability of default and the degree of risk aversion of bondholders. Figure 6.3 plots the interest rates on three types of bonds since 2000. US government bonds, which are considered merely riskless, and corporate bonds rated as safe, AAA, and less safe, BBB, by ratings agencies. You can see how the risk premium affects market rates of interest. It illustrates the impact of risk premia on the interest rates at which different organizations could borrow. In September 2008, the financial crisis led to a sharp increase in the rates at which firms could borrow. Section 6.3, the role of financial intermediaries. Until now, we have looked at direct finance, borrowing directly by the ultimate borrowers from the ultimate lenders. In fact, much of the borrowing and lending takes place through financial intermediaries, financial institutions that receive funds from investors and then lend these funds to others. Among these institutions are banks, but also increasingly non-banks such as mortgage companies, money market funds, and hedge funds. Financial intermediaries perform an important function. They develop expertise about specific borrowers and can tailor lending to their specific needs. In normal times, they function smoothly. They borrow and lend, charging a slightly higher interest rate than the rate at which they borrow so as to make a profit. Once in a while, however, they run into trouble, and this is what happened in the great financial crisis. To understand why, let's first focus on banks and start in figure 6.4 with a much simplified bank balance sheet. Figure 6.4 shows a sample commercial bank's assets, capital, and liabilities. The bank balance sheet consists of two columns, one on the left and the other on the right. The left column has the following information. The bank has assets equal to $100. These could be cash, reserves in the bank's vault or deposits at the Fed, US Treasury bills, loans to people or firms such as mortgages or business loans or student loans or loans to other banks. Assets could be more complex, such as mortgage-backed securities, which are essentially packages of different kinds of mortgages bundled together. These assets are less liquid than US Treasury bills. They would be harder to sell in case the bank needed to raise cash quickly. The right column shows bank has liabilities equal to $80. These may be the demand deposits that customers hold or money that the bank has borrowed from other banks. Capital is the difference between assets and liabilities. This bank has capital equal to $20. You can think of the owners of the bank as having invested $20 of their own funds. Capital is entered in the right column. It plays an important role. The sum of liabilities and capital must be equal to the assets on the bank's balance sheet. If liabilities become greater than assets, the bank would be insolvent. Two important definitions in understanding the financial crisis are capital ratio, the ratio of capital to assets. In our example, this is equal to 20 over 100 equals 20%. Leverage ratio, the ratio of assets to capital, which is 100 over 20 equals 5. In thinking about what leverage ratio it should choose, the bank has to balance two factors. A higher leverage ratio implies a higher expected profit per unit of capital, but also implies a higher risk of insolvency and bankruptcy. Leverage and lending. Suppose a bank has chosen its preferred leverage ratio, and suppose that the value of its assets declines. For example, the assets of the bank in figure 6.4 decrease in value from 100 to 90, say as a result of bad loans. The capital of the bank would be now down to 90 minus 80 equals 10. Its leverage ratio would increase to 90 over 10 equals 9 from 5. The bank is still solvent, but it is clearly more at risk than it was before. What will it want to do? It may want to increase capital, for example, by asking other investors to provide funds, but it is also likely to want to decrease the size of its balance sheet. For example, if it can call back some loans for an amount of 40 and thus reduce its assets to 90 minus 40 equals 50, and then use the 40 to decrease its liabilities to 80 minus 40 equals 40. Its capital ratio, i.e., the ratio of capital to assets, will be 10 over 50 equals 20%, back to its original value. But although the capital ratio is back to its desired level, the effect is a sharp decrease in lending. If the decline in value of assets is large, say from 100 to 70, the bank will become insolvent and go bankrupt. This has huge macroeconomic implications. Liquidity. We saw that when bank assets decline in value, banks will reduce lending. Now consider a case in which investors are unsure of the value of the assets of the bank and believe, right or wrong, that the value of the assets may have come down. Then leverage can have disastrous effects. The bank will find it very hard to call back the loans since the borrowers are unlikely to have funds at the ready. The banks may need to sell their assets, loans. The lower the liquidity of bank assets means, the more difficult they are to sell. The higher the risk of being sold at fire sale prices, prices far below the true value, and the risk that the bank becomes insolvent. The higher the liquidity of the liabilities, example, checkable, or demand deposits, the higher the risk of fire sales and the risk that the bank becomes insolvent and thus faces bank runs. Again, the reason this is relevant for us is that such bankruptcies, if they occur, may well have major macroeconomic consequences. Focus: bank runs. Bank runs follow a similar pattern. Take a healthy bank, that is, a bank with a portfolio of good loans. Suppose rumors start that the bank is not doing well and some loans will not be repaid. Believing that the bank may fail, people with deposits at the bank will want to close their accounts and withdraw cash. If enough people do so, the bank will run out of funds. Given that the loans cannot easily be called back, the bank will not be able to satisfy the demand for cash and it will have to close. Deposit insurance was enacted to limit bank runs. The US financial history up to the 1930s is full of bank runs, as seen in the classic movie It's a Wonderful Life. One potential solution to bank runs is narrow banking, which restricts banks from making loans and to hold liquid and safe government bonds. To limit bank runs, the United States introduced Federal Deposit Insurance in 1934. The Fed also implemented liquidity provision so that banks could borrow overnight from other financial institutions. Section 6.4: Extending the ISLM. The ISLM model, introduced in Chapter 5, had only one interest rate. It was determined by the central bank and it entered spending decisions. It appeared both in the LM relation and the IS relation. The first three sections of this chapter showed that, although this was a useful first step, reality is substantially more complex and we must extend our initial model to account for different rates of interest. Now we extend the ISLM to reflect the distinction between 1. The nominal interest rate and the real interest rate, 2. The policy rate set by the central bank and the interest rates faced by borrowers. Note: 1. The interest rate that enters the IS relation is the real interest rate given by the difference between the nominal interest rate I and the expected inflation rate pi e. 2. The interest rate that matters for borrowers is the real interest rate plus the risk premium x. The central bank chooses the real policy rate R. The interest rate faced by borrowers, which determines aggregate demand in the economy, is dependent on the expected inflation rate pi e and the risk premium x, which enter the IS relation. Rewrite the ISLM. IS relation: y equals c within brackets y minus d plus I within brackets y comma I minus pi e plus x bracket close plus g. LM relation: I equals I bar, where expected inflation pi e and the risk premium x enter the IS relation. After the financial crisis, the role of risk premia has become evident. The central bank now chooses the real policy rate R, which enters the IS equation as part of the borrowing rate R plus X for consumers and firms. Equation 6.5 shows the IS relation with investment being dependent on y and r plus x. Equation 6.6 shows the new LM relation in terms of the real interest rate r. IS relation y equals c within bracket y minus t plus I within bracket y comma r plus x close bracket plus g. Equation 6.5. LM relation r equals r bar. Equation 6.6, where expected inflation pi e and the risk premium x enter the IS relation. Figure 6.5 shows the effect of financial shock on equilibrium output. The two equations 6.5 and 6.6 are represented in figure 6.5. The policy rate, the real interest rate implicitly chosen by the central bank, is measured on the vertical axis and output on the horizontal axis. The IS curve is drawn for given values of G, T, and X. All other things equal, an increase in the real policy rate decreases spending and in turn output. The IS curve is downward sloping. The LM is a horizontal line at the real policy rate. Equilibrium is given by point A with associated level of output Y. Increase in X risk premium leads to a shift of the IS curve to the left from IS to IS prime and a decrease in equilibrium output from Y to Y prime. Figure 6.6 shows how monetary policy can be used to counter the effects of an increase in the risk premium. Given that the cause of the low output is that the interest rate for borrowers is too high, monetary policy appears to be a better tool. Indeed, a sufficient decrease in the policy rate, as drawn in figure 6.6, can in principle be enough to take the economy to point A double prime and keep output to its initial level. If sufficiently large, a decrease in the policy rate can in principle offset the effect of an increase in the risk premium. The zero lower bound may, however, put a limit on the decrease in the real policy rate. From a housing problem to a financial crisis. Housing prices and subprime mortgages. Figure 6.7 shows the evolution of an index of U.S. housing prices since 2000. The index is known as the Case-Shiller Index, named for the two economists who constructed it. The index is normalized to equal 100 in January 2000. You can see the large increase in prices in the early 2000s, followed by a large decrease. From a value of 100 in 2000, the index increased to 226 in mid-2006. It then started to decline. By the end of 2008, at the start of the financial crisis, the index was down to 162. It reached a low of 150 in early 2012 and started recovering thereafter. At the time of this writing, it is 227, close to its mid-2006 peak. The role of financial intermediaries. One factor that contributed to the housing problem was the general belief that houses would always increase in value. Judging from the past, the assumption that housing prices would not decrease seemed reasonable. As you can see from figure 6.7, housing prices had not decreased even during the 2000-2001 recession. However, This assumption proved not to be true. The 2000s were a period of unusually low interest rates which stimulated housing demand. Mortgage lenders were increasingly willing to make loans to risky borrowers with subprime mortgages or subprimes. From 2006 on, many home mortgages went underwater when the value of the mortgage exceeded the value of the house. Lenders faced large losses as many borrowers defaulted. Leverage. In the previous section, we saw that high leverage, illiquidity of assets, and liquidity of liabilities all increase the risk of trouble in the financial system. All three elements were present in 2008, creating a perfect storm. Banks were highly leveraged because banks probably underestimated the risk. Bank managers had incentives to go for high expected returns without fully taking the risk of bankruptcy into account. Banks avoided financial regulations with structured investment vehicles (SIVs). Banks created new products through securitization, which is the creation of securities based on a bundle of assets such as mortgage-based securities (MBS). Securitization and illiquidity of assets. Securitization is the creation of securities based on a bundle of assets, example loans or mortgages. The advantage is that many investors who would not want to hold individual mortgages will be willing to buy and hold these securities. This increase in the supply of funds from investors is, in turn, likely to decrease the cost of borrowing. Securitization also allowed banks to diversify their loan portfolios and reduce their exposure to local economic conditions. Senior securities have first claims on the return from the bundle of assets. Junior securities, such as collateralized debt obligations (CDOs), come after. Securitization was a way of diversifying risk, but it came with costs. The bank that sold the mortgage had few incentives to keep the risk low. Even for toxic assets, the risk is difficult for rating agencies to assess. Wholesale funding. Yet another development of the 1990s and 2000s was the emergence of sources of finance other than checkable deposits by banks. Wholesale funding again would seem like a good idea, giving banks more flexibility in the amounts of funds they could use to make loans or buy assets. But it had a cost which became clear during the crisis. When the investors in these SIVs asked for their funds back, banks had to comply. Banks and SIVs had liquid liabilities, much more liquid than their assets. Wholesale funding is a process in which banks rely on borrowing from other banks or investors to finance the purchase of their assets. In 2000s, SIVs were entirely funded through wholesale funding. Wholesale funding resulted in liquid liabilities. Macroeconomic implications. Figure 6.8 shows US consumer and business confidence 2007 to 2011. The financial crisis led to a sharp drop in consumer and business confidence from 2007 to 2009, which in turn affected output. It bottomed in early 2009. The vertical axis of the graphs is labeled Index of Confidence. January 2007 equals 100 and ranges from 0 to 120 in increments of 20. The horizontal axis represents the first and seventh months of each year from 2007 to 2011. As you can see in figure 6.8, the deteriorating conditions took a toll on consumer confidence. Consumer confidence had started declining in mid-2007, but it took a sharp turn in the fall of 2008 and reached a low of 22 in early 2009, far below historical lows. The result of low confidence and lower housing and stock prices was a sharp decrease in consumption. Policy responses. The most urgent policy measures were aimed at strengthening the financial system. The demand for goods decreased due to the high cost of borrowing, lower stock prices, and lower confidence. The IS curve shift to the left. Policymakers responded to this large decrease in demand with financial policies, monetary policy, and fiscal policy. Financial policies. The financial policies were all designed to restore faith in the financial system as well as to shore up financial institutions to prevent collapse. Federal deposit insurance was raised from $100,000 to $250,000. The Fed provided widespread liquidity to the financial system through liquidity facilities and increased the number of assets that could serve as collateral. The government introduced the Troubled Asset Relief Program, TARP, aimed at cleaning up the bank's balance sheets of complex assets. Monetary policy. The Fed also began to take action. Since the Fed funds rate was zero lower bound, the Fed then turned to what has become known as unconventional monetary policy, buying other assets so as to directly affect the rate faced by borrowers. Fiscal policy. The American Recovery and Reinvestment Act was passed in February 2009, calling for $780 billion in tax reductions and spending increases. Figure 6.9 shows the impact of the financial crisis and the use of financial, fiscal, and monetary policies to stabilize the economy. We can summarize our discussion by going back to the ISLM model we developed in the previous section. This is done in figure 6.9. The initial shock was so large that the combination of financial, fiscal, and monetary measures was just not enough to avoid a large decrease in output. US GDP fell by 3.5% in 2009 and recovered only slowly thereafter. The financial crisis led to a shift of the IS curve to the left from IS to IS prime. Economy moved from point A to B. Financial and fiscal policies led to some shift back of the IS curve to the right from IS prime to IS double prime. Monetary policy led to a shift of the LM curve down from LM to LM prime. Economy moved from point B to A prime. Policies were not enough, however, to avoid a major recession. Economy went from point A before the recession to point B as a result of the financial crisis. Expansionary fiscal and monetary policies, along with financial measures, moved the economy to point A prime, where output y prime is smaller than the output y at point A before the crisis.